The Goldman Sachs 2025 institutional forecast, U.S. home prices are projected to increase 1.9% in 2026. The National Association of Realtors projects 4.0% growth. The Mortgage Bankers Association predicts negative 0.3%. These aren't estimates for different markets. They're forecasts for the same National Housing Index. One analysis predicts a 50 to 60% price collapse. Another shows record homeowner equity totaling $17.5 trillion. Let's open the file on 2026. The fixation on 2026 originates with British economist Fred Harrison. Harrison published forecasts predicting the 2008 financial crisis based on what he called the 18-year property cycle. The model tracks land speculation patterns dating back to 1800s British property records. Harrison documented crashes in 1935, 1954, 1973, 1989, and 2008. Each cycle measured approximately 18 years from trough to peak. The theory divides into three phases: recovery phase, 7 years; explosive growth phase, 7 years; winner's curse phase, 4 years, ending in collapse. By this calculation, the 2008 bottom plus 18 years targets 2026 as the next peak. Harrison's model assumes credit cycles tied to land scarcity drive the pattern. The final phase is characterized by detachment from fundamental value. Parallel to Harrison is economist Harry Dent. Dent focuses on demographic spending waves rather than credit cycles. He published projections in 2024 calling for home price declines of 50 to 60% by 2026. Luxury properties, he stated, could fall 70 to 80%. Dent's thesis centers on the baby boomer generation aging out of peak spending years. He terms this the silver tsunami. The argument: boomers will flood the market with inventory as they downsize or pass away. Generation X and millennials cannot absorb the supply due to affordability constraints. But institutional forecasts show different numbers. The National Association of Realtors projects 2026 home prices will increase 4.0%. They forecast sales volume will surge 14% as pent-up demand releases. Zillow's model shows growth between 1.5% and 1.9%. Fannie Mae, 1.3%. Goldman Sachs, 1.9%. CoreLogity, 3.9%. The Mortgage Bankers Association is the outlier at negative 0.3%. The divergence centers on one structural factor: equity. U.S. homeowners held $17.5 trillion in equity as of 2025. The average borrower accumulated approximately $307,000 in equity. The average loan-to-value ratio sits at 44%. In 2008, the average LTV ratio approached 85%. Millions of homeowners were underwater. They owed more than the property was worth. In 2026, even in softening markets like Florida, the average homeowner retains roughly $290,000 in equity. This creates what analysts call the equity firewall. A distressed homeowner in 2026 can sell on the open market and walk away with cash. In 2008, distressed homeowners had no equity to extract. They defaulted. Banks foreclosed, properties sold at fire sale prices. The forensic difference: forced selling versus voluntary holding. Approximately 70% of mortgage holders are locked into fixed rates of 5% or lower. Many sit below 3%. The 30-year mortgage rate in 2026 is projected between 6.0 and 6.7%, according to J.P. Morgan forecasts. A homeowner with a 3% mortgage would need to accept a 6.5% rate to move. The monthly payment difference on a $400,000 loan is approximately $1,100. This is the lock-in effect. It constrains supply. Active listings in 2025 measured approximately 1.53 million homes. A balanced market requires 2 to 2.5 million. Housing starts declined 2.8% in 2025. Builders pulled back due to elevated interest rates. The structural deficit is estimated at 3 to 4 million homes since 2008. The audit shows a market with high equity, constrained supply, and borrowers financially disincentivized to sell. But regional data tells a different story. Florida inventory more than doubled between early 2022 and 2025. The state recorded the largest annual equity decline in 2025 alongside the District of Columbia. Texas, Arizona, and Tennessee show similar patterns. These Sunbelt states experienced explosive growth during the pandemic as remote work enabled migration from coastal cities. In 2026, that migration flow stalled. Return to office mandates recalled workers. The artificial demand support collapsed. Austin and Nashville inventories surged. Listings in these cities shifted from seller's market to buyer's market conditions. The data shows bifurcation. Rust Belt cities like Cleveland, Hartford, and Chicago continued appreciation. These markets did not experience pandemic run-ups. Their relative affordability attracted buyers priced out of Sunbelt markets. Within the Sunbelt, the condominium sector faces acute distress. Florida enacted regulations following the Surfside collapse requiring fully funded reserve accounts. Condo associations issued special assessments ranging from $20,000 to $100,000 per unit. Simultaneously, homeowner insurance premiums in Florida averaged nearly $6,000 annually in 2025. This is double the national average. Major carriers, including Farmers and AAA, withdrew from the Florida market entirely. The forensic mechanism. An unexpected $200 per month insurance increase reduces buyer power by $30,000 to $40,000. Properties in high-risk coastal zones became unmortgageable without private insurance. The insurance crisis created forced selling independent of broader economic trends. A parallel distress signal emerged in the short-term rental sector. Active Airbnb listings climbed to 1.1 million in 2025. This represented a 17% year-over-year increase. Occupancy rates fell to approximately 50%. Revenue per available rental declined in saturated markets. Investors who purchased properties in 2021 and 2022 using debt service coverage ratio loans assumed pandemic-era occupancy would continue. As revenues fell and operating costs rose, these assets became cash flow negative. Cities like New York, Santa Monica, and Irvine implemented strict short-term rental bans. The regulatory wave accelerated in 2026. When a short-term rental becomes illegal or unprofitable, the owner is forced to sell. In Austin, Phoenix, and Sevierville, Tennessee, this shadow inventory hit the resale market. Short-term rentals comprise less than 1% of total U.S. housing stock, but they concentrate in specific neighborhoods. Mass sell-offs in these districts crashed local comparable sales. The ledger shows divergence. National metrics mask regional extremes. The Canadian market operates under a different structure. Canadian mortgages typically carry 5-year terms, even with 25-year amortization schedules. The interest rate resets every 5 years. In 2026, approximately 2 million Canadian mortgages are scheduled to renew. This represents nearly 60% of outstanding mortgages. These loans originated in 2021 at rates near 2%, but will renew at rates between 4 and 6%. RBC Economics calculated monthly payments could increase 30 to 48%. The total liquidity shock is estimated at $900 billion. Many variable rate borrowers already hit trigger rates. Their monthly payments cover interest only. Unpaid interest adds to the loan balance. This is negative amortization. Upon renewal, borrowers must revert to the original amortization schedule. This requires either a lump sum payment or drastically increased monthly payments. For many, this is mathematically impossible. The forensic prediction: forced sales in the Greater Toronto Area and Vancouver. ABC Economics projects home prices in Ontario and British Columbia will decline in late 2025 and through 2026. The investor segment, particularly pre-construction condos in Toronto, shows panic selling via assignment sales. The Canadian renewal cliff represents systemic risk absent in the U.S. market. UBS and Goldman Sachs project China's property sector will not stabilize until late 2026 or 2027. Pre-owned home prices in top-tier Chinese cities are forecast to decline another 10% in 2026. Rental yields in Tier 1 cities average 1.8%. Mortgage rates hover around 3%. The economic incentive to purchase is negative.
The belief that real estate functions as a risk-free wealth store has been shattered. Chinese property market declines create deflationary pressure on global construction materials, including steel, copper, and lumber. This secondary effect lowers construction costs for U.S. builders. The slowdown in China paradoxically supports U.S. supply-side capacity. The institutional consensus does not support a 50% national price collapse. The structural differences between 2008 and 2026 are forensic. In 2008, the average LTV was 85%. In 2026, it is 44%. In 2008, toxic credit products including ninja loans and negative amortization ARMs were widespread. In 2026, lending standards remain tight. Fixed-rate mortgages dominate. In 2008, oversupply flooded the market. In 2026, a structural deficit of 3 to 4 million homes persists. The equity firewall prevents the foreclosure cascade that defined 2008. Distressed homeowners can sell and extract cash rather than default. But this does not mean stability. The 2026 market is characterized by what analysts term the transactional crash. Sales volume remains frozen. Buyers cannot afford entry. Sellers refuse to move up due to rate lock-in. The market grinds. Nominal prices remain flat or grow minimally. Inflation erodes real values over time. This is the time correction. Wages must catch up to prices. The process takes years. Regional bifurcation is severe. Sunbelt markets face correction. Inventory gluts and insurance crises create localized crashes. Florida condos and short-term rental concentrations see distressed selling. Canada faces systemic risk from the renewal cliff. China's deflation continues. The national U.S. market does not crash, it stagnates. Goldman Sachs projects 1.9% growth. Dent projects 50% collapse. The institutional models rely on equity cushions and supply deficits. The cycle theorists rely on historical patterns and demographic cliffs. The forensic data supports stagnation, not collapse. Regional corrections, not national crashes. The 2026 housing market is not 2008. It is the beginning of a new era defined by affordability lockout and regional fragmentation. The missing piece: forced selling. Without it, prices hold. Should the regulators have anticipated the insurance crisis earlier? Did the lock-in effect prevent price discovery? Where do you think the next housing shock originates?